That lump sum hits your bank and it feels like you won, like a bonus, right? Millions wait for that moment, refreshing a tracker like it's a payday ritual. But what if that feeling is part of the design, not an accident of paperwork? Subscribe to Money Explained Money, simplified. Because your tax refund isn't free money, it's the system settling a mismatch. And sometimes it's not your own overpayment at all, but a credit paid out. So why does the system create a refund moment instead of getting it right daily? Why collect money all year, then hand some back later, like a reversal? Because your final tax bill isn't fully knowable until the year is complete. Income changes, family changes, and eligibility rules change inside the year. A bonus, a job change, or freelance income can rewrite what the final bill is. So the system uses a proxy. Withholding, an estimate taken from each paycheck. Withholding is tax prepaid before the system can compute the final number. Some people also prepay via estimated taxes when income isn't payroll-based. Then the tax return is reconciliation, the end-of-year accounting close. Reconciliation means prepaid minus owed equals refund or balance due. That's the plumbing choice. Steady collection first, precise calculation later. So a refund is often your own money returning after the system checks the math. The key word is often because refunds can come from a second pipe too. Picture two pipes feeding the same final refund number on your screen. Pipe 1, correction of overpayment, where your prepaid tax comes back to you. Pipe 2, refundable credits, benefits delivered through the tax system. Put it on screen big, same word, different source, and it changes behavior. Because when both look identical in your bank app, your story about it shifts. Now, the common belief is fair. A refund means the government gave me extra, but that's incomplete. Because a correction isn't a gift, it's a reversal. It's like a utility bill estimate being too high, then corrected at year-end, and the system quietly prefers overcollection to undercollection. Why would it prefer that if it makes refunds common and confusing? Because overcollection reduces the risk of large underpayment at filing time. That lowers non-payment risk and reduces costly enforcement work for the agency. And it reduces public backlash because refunds feel nicer than surprise bills. That's not blame, it's incentives. Tolerance and compliance are system goals. Now zoom back to pipe 2 because this is where people miss the mechanism. A refundable credit can pay out even if your income tax due is 0. Income tax due means the final liability after rules, credits, and deductions. So a refund can be a payout by design, not just your money returning. Same refund label, 2 different origins, 1 combined number, 1 emotion. And that creates an information gap. You see withholding, not your true bill. You only see the final truth after filing when the system reconciles the year. So the system creates uncertainty first, then resolves it in one settlement event. And that settlement timing has a second-order effect most people never name. Because timing changes meaning lump sums feel like windfalls, even when they're not. That's why refund season becomes a ritual with trackers, memes, and countdowns. It's also why the system offers status tools visibility, reduces pressure on the pipe. Behind the scenes, refunds move through steps. Receive, validate, approve, pay. Validation is the check that the return passes rules and anti-fraud filters. And then it hits payment rails, the channel's money travels on into your bank. Now here's the oh wow part. Refunds don't just settle tax, they shift spending. Research from the Federal Reserve finds spending rises when EITC refunds arrive. And when those refunds are delayed, that spending shift is delayed too. Same dollars, different day, and the economy experiences it like a timed pulse. So the annual settlement isn't only personal cash flow, it becomes macro rhythm. People start planning life around a date the system controls, not a paycheck. Rent catch-ups, repairs, big bills timing becomes a survival strategy. Not because people are irrational, but because the plumbing taught the rhythm. Now, the biggest insight is the quiet cost of that rhythm, opportunity cost. Opportunity cost means what money could have done elsewhere during that same time. A refund from Pipe 1 implies your money sat with the system, not with you. Think of it as a delayed, zero-interest loan created by overwithholding. Here's a concrete example, clearly hypothetical, to anchor the idea on screen. Imagine a $2,000 refund that could have sat in a 5% savings account for a year. That's about $100 of interest you didn't earn, simply because of timing. Change the rate, and the number changes, but the mechanism stays the same. The cost isn't only returns, it's flexibility, because timing is a form of power. If you're living close to the edge, a delay is not a nuisance, it's a shock. So the plumbing sorts households by who can absorb timing risk and who can't. That's a system effect, not a character judgment, and it compounds over years. Now ask yourself, when you see a big refund, what story do you tell yourself? Do you hear, "I won," or do you hear, "The system reconciled what was already true"? And do you know which pipe your refund came from, or is it just one number? Drop your take in the comments and share what refunds feel like in real life. If you've got questions, put them in the comments and we'll answer the key ones. Because refunds aren't a morality tale, they're a design choice in tax plumbing. Reframe it like this: a refund is a settlement statement, not a surprise prize. Two pipes, one number, correction, and credit, and the label hides the source. And the next layer is darker. Who benefits from the float between pay in and pay out?